Hi, today I wanted to share some information regarding credit scores and why it's so important to have your score as high as possible. See, it's not just a number, it's what we use to determine what sort of rate we're going to get you. And the higher your credit score is, the better the rate, the better the terms that you're going to get. So let's just take, for example, if you were going to borrow $300,000 and one borrower is getting an interest rate of 6% while the other one's getting an interest rate of 6.5%. That's going to be roughly $100 a month difference in the payment, which doesn't sound like a whole lot, but at the same token, when you add that up over the next several years, you're talking several thousands of dollars that you're paying more simply because your credit score was not quite as good as the other individuals. So it's really important to do what you can to have that score as high as possible. So let's talk about that a little bit further with regards to what lenders look at and how they determine these rates. 780 or higher is going to get you the best rate, best terms available out there typically. And so that's in that A plus. If you fall in that 760 to 779, you're still going to get a really good rate. It's just not going to be quite as good as that 780 plus. And so that's going to be maybe more of an A to A plus versus that A plus. Okay. If you fall now between 700 and 760, that's still going to get you a good rate. It's still going to be very competitive. Falling below 700, if you're 620 to 700, that's still acceptable. And in fact, if we were to do, say, an FHA, VA, USDA, that's going to be more than acceptable. On the conventional side, however, you are going to have an impact as far as what kind of a rate you're paying if you're in that range. And if you're interested in down payment assistance, typically most of those require between 620 and 640, just depending upon the program. So that's also something to kind of keep in mind as you're looking at all this. So what makes up the score? How does this impact you? For starters, over 1/3 of your score, 35%, is based on your on-time payments, your payment history. So if you're paying everything in a timely fashion, that's going to account for 1/3 of your score. That's going to be really good for you in terms of getting that score up there. Make sure you pay your bills on time. Number two, it's going to look at utilization, credit utilization. So what does that mean? That means on your revolving debt, let's just say, for example, you have a $10,000 limit on your card and you owe $7,000 on it. That's a 70% utilization. That's going to drive your credit score down because there's so much utilization. You don't have a lot available and you've not quite, but you're on the verge of maxing out your credit card. You ideally want to be at 30% or less. The lower the better. So in that scenario, even having a $3,000 balance against your $10,000 limit is still going to be good, but if you can get it down to $2,000, even better. And then as far as other things to be mindful of, if you check your credit and there's things that are on there that are erroneous, make sure and dispute those and try and get them removed. If you have collections on there, for example, that don't belong to you, that's going to be a way for you to get those off, dispute them, and then that should raise your credit score as well. Make sure you don't have any erroneous information on there, things that don't belong to you. Also, do yourself a favor. If you've got an old credit card and maybe you just haven't used it very much, don't close it out because it looks at your overall payment history. In fact, what I recommend is if you've got a credit card that is a little older, every now and then maybe just charge $10 or $20 on it. And when the bill comes, just pay it off. That way, that kind of keeps that payment history going. You don't have to worry about the utilization and you're in good shape there. Again, the minute you close that out, it's almost like that card didn't exist. So keep that in mind. Don't close out a lot of your old accounts. And then the other thing, obviously, that impacts scores is hard inquiries. Now, I'm not talking about one hard inquiry. I'm talking about several in a short period of time. So if you were to do a hard inquiry every 3 or 4 months, that's not going to really have a great impact on your score. It's going to impact it slightly, but not a ton. What's going to hurt you is if you have 4, 5, 6 inquiries in that same period of time. And whenever you don't go and make a big purchase right before you're getting ready to qualify for a mortgage, because that's going to result obviously in a hard inquiry. It's also going to show this new debt that there's no payment history on. So be mindful of that. Don't do that if you can help it. All right, listen, I hope you found this information helpful. If you have more questions regarding credit, how it works, how it impacts your score, please feel free to call us, text us. We're always here to answer your questions. If you can do me a favor, if you found this information helpful, please do me a favor and subscribe to our page. And definitely, if you know of any friends or family that have questions around credit and credit scores and how it impacts things, feel free to forward this to them. I would be grateful for both of those things. All right, listen, you have a great day. We'll talk to you soon. Bye-bye.